So what I'm going to talk to you about is a payments tax and how a payments tax can be used to eliminate income taxes. Not only eliminate all the income taxes that you pay personally, but all corporate income taxes. It would also eliminate all sales taxes. It could also eliminate property taxes. So if you own a house, you know what a significant difference that would make. The whole challenge behind taxes really comes down to the fact that as our country progressed, we would change our tax base as the economy would change. So at one time we taxed sugar, another time we taxed cotton. In 1913, we established the income tax, and it was the right tax at that time. Income was the dominant force in the economy. It was what you might call the 900-pound gorilla. By 1970, that began to change. In 1970, wages began to flatten out. And for the past decades, wages have remained the same, while the economy has continued to become much bigger. So it's just simply you're taxing the wrong thing when you're taxing income. So let's look at how the numbers would work on a payments tax and why it would be so beneficial. Your goal in paying taxes or in collecting taxes is to generate the revenue that the government spends. So you've got states spending money, you've got the federal government spending money, and you have cities spending money. If you take the total budgets of all states, cities, and the federal government in our country, it comes to $5 trillion. $4 trillion of that is the federal. The other $1 trillion is state and local. So your goal is to collect $5 trillion, and the total income of all Americans comes to $16 trillion. So to derive 5 out of 16, that means taxes have to be around a third of your income. And they are pretty high today. In the meantime, if you look at the alternatives out there, the cheapest tax that you could ever have in an economy, the largest base, in other words, would be every single time money changed hands, every time there was a payment. And that figure comes out to be $5,000 trillion in 1 year. So compare 16 trillion in income to 5,000 trillion in payments, and you could see it's a lot different. In other words, you're taking that 5 trillion, think of it as a ladle. You're scooping 5 trillion out of a bucket. If you scoop it out of the $16 trillion bucket, you're taking a third. But if you scoop it out of the $5,000 trillion ocean out there, that's 1/10 of 1%. So tax rates would plummet from 30-some% down to 1/10 of 1%. So for an individual earning $100,000, today they actually, between sales tax, property tax, and income taxes, end up spending around $45,000 of their $100,000 in income. Under this system, it would cost them $100. Phenomenal difference simply because we're taxing the right thing. Now, what's interesting about that is what would happen if we were to take 0.2 of 1% instead? So that individual who was earning $100,000 and paying $45,000 would now be taxed at $200. Still, no big deal, right? At $200, we would not have a deficit in any state. We would no longer have a federal deficit at all. We'd have a balanced budget. And we'd have so much extra money, we could pay every citizen who is 18 and over $24,000 in universal basic income. We could pay free health care for everybody, and you could have free college. The payments tax solves a great deal of the problems in our economy. It lessens the tax burden, which means that the amount of money that people are paying in taxes they now have, and they can begin to spend it. So you have consumer spending going up, which is very good for business. So it's good for individuals, good for business, and good for the governments. That's why a payments tax is where we need to go today. And we need to eliminate income taxes, sales taxes, and property taxes.